There is a mortgage product that helped trigger the worst financial crisis of the last century. Millions of families lost their homes because of it. After 2008, it nearly vanished. By the end of that year, it made up less than 1% of new mortgages. Right now, in 2026, it has come roaring back. Adjustable rate mortgages are at their highest share of new home loans since 2008, up over 100% in a single year. And here is the detail that should genuinely surprise you. This is not happening because buyers don't know the history. It's happening because, this time, they're choosing it with their eyes open. Today, we're going to walk through exactly why this loan is back, what's genuinely different about it this time, and what's still genuinely risky, so you know exactly what you'd be signing up for if this ever hit your desk. Here's why so many buyers are looking at this product again. The 30-year fixed mortgage rate has been sitting stubbornly in the 6 to 6.5% range for most of 2026. Home prices remain near record highs in most major markets. For a huge number of would-be buyers, the math simply doesn't work at those numbers. They don't qualify for the loan they need at the price of the home they want on a 30-year fixed rate. An adjustable rate mortgage offers something specific. A 5/1 ARM right now carries a rate roughly half a point to a full point lower than the 30-year fixed. On a $400,000 loan, that gap translates into roughly $200 or more in monthly savings. For many first-time buyers, that $200 isn't a nice bonus. It's the entire difference between qualifying for a mortgage and being shut out of the market completely. Here's exactly what an ARM is, and why it behaves so differently from the mortgage most Americans grew up trusting. A 30-year fixed mortgage locks your interest rate for the entire 3 decades. Your principal and interest payment never changes. An ARM works differently. It carries a fixed rate for an initial period, typically 5, 7, or 10 years, usually written as 5/1, 7/1, or 10/1. After that period ends, the rate resets, adjusting annually based on broader market rates. Here's what made the pre-2008 version of this loan so dangerous. In the years leading up to the crisis, ARMs often carried fixed periods of just 2 or 3 years, with artificially low teaser introductory rates. Lenders frequently approved borrowers based only on their ability to afford that initial teaser payment, not the higher payment that would eventually arrive. When those short teaser periods ended, payments sometimes jumped dramatically, all at once, for borrowers who were never actually qualified to afford the real rate in the first place. ARMs made up as much as a third of all mortgage originations during that bubble. Remember that opening warning that buyers are choosing this loan with their eyes open this time? Here's the regulatory change that actually backs that up. Today's lenders are legally required to qualify borrowers based on their ability to pay the fully indexed rate, the rate that would apply after the adjustment, not just the low introductory rate. That single underwriting rule is the difference between this generation's ARMs and the version that helped collapse the global economy. Let's go through the honest comparison, point by point, because both the reassurance and the risk in this story are real. Genuinely different. Point 1. Rate caps. Modern ARMs come with strict limits on how much the rate can move, typically a cap of around 2% on any single adjustment, and a lifetime cap of around 5% over the life of the loan. The uncapped runaway resets of the subprime era are no longer standard practice. Genuinely different. Point 2. Who's actually taking these loans out? Today's ARM borrowers typically need high credit scores, larger down payments, and documented income sufficient to handle the worst-case adjusted payment. Research from the Urban Institute concluded that current generation ARMs are no riskier on a structural basis than other mainstream mortgage products. Genuinely different. Point 3. The typical fixed period is longer. Where pre-crisis ARMs often had 2 or 3 year teaser periods, today's products typically lock in for 5, 7, or even 10 years, giving borrowers significantly more time before any adjustment hits. Now, here's what hasn't actually changed, and where the real risk still lives. Payment shock is still completely real. Industry experts are explicit about this. Even with caps in place, a loan that starts manageable can become genuinely unaffordable once the adjustment arrives, especially if a borrower's income, expenses, or credit situation has shifted in the meantime. And there's a behavioral risk that caps alone don't solve. Borrowers can get comfortable with several years of lower payments and stretch other parts of their budget to match a car loan, a renovation, a lifestyle upgrade, so that even a capped, disclosed rate increase becomes difficult to absorb when it finally lands. The product is safer than it was in 2008. It is not risk-free. Those are two different statements, and this entire trend depends on people understanding the difference. Here's the honest framework for deciding whether this loan belongs in your situation. Move 1. Be honest about your actual timeline in the home. ARMs work best for buyers who genuinely expect to sell or refinance before the initial fixed period ends. First-time buyers planning to upgrade within 5 to 7 years, or buyers anticipating a job relocation, are the textbook use case this product was built for. If there's a real chance you'll still be in that home when the rate resets, you need to plan for the adjusted payment, not just the introductory one. Move 2. Before signing anything, ask your lender for the worst-case payment, not just the starting payment. Specifically, ask what your monthly payment would be if the rate hit its lifetime cap. If that number would meaningfully strain your budget, the loan is too risky for your situation, regardless of how attractive the introductory rate looks today. Move 3. Understand exactly what index and margin determine your future rate and what the adjustment schedule actually looks like. A 5/1 ARM and a 5/6 ARM, for example, both have a 5-year fixed period, but adjust at very different frequencies afterward. Know precisely how often and by how much your payment can move once the fixed period ends. Move 4, and this is the one that protects you regardless of which way rates move. Treat the monthly savings from an ARM as money to actively prepare for the adjustment, not as money to spend. If a 30-year fixed payment would have been $200 more per month, redirect that exact $200 into savings throughout your fixed period. By the time your rate adjusts, you'll have built a real cushion specifically sized to absorb whatever payment increase actually arrives. This loan earned its dangerous reputation honestly. The product that existed in 2005 deserved the fear it created. The product available today has real, regulator-imposed differences that make it a legitimately useful tool for the right borrower in the right situation. The mistake isn't choosing an ARM. The mistake is choosing one without fully understanding what happens after the introductory period ends.
Here's what's actually happening. Adjustable rate mortgages have surged to nearly 13% of all applications, the highest share since 2008, up over 113% in a single year, as elevated fixed rates push buyers to look for any way to qualify. In high-cost markets like California, ARMs now account for nearly a third of all new mortgages. What's different this time? Strict rate caps, qualification based on the worst-case payment, and longer fixed periods. What hasn't changed? Real payment shock risk if your timeline or budget shifts before the adjustment hits. Your 4 moves. Be honest about how long you'll actually stay in the home. Ask for the worst-case payment before you sign. Understand your specific index, margin, and adjustment schedule. And bank the monthly savings instead of spending it, so you're ready regardless of where rates go. The loan that helped break the housing market in 2008 is back. This time, you get to decide whether you understand it before it ever becomes a problem. If this video helped you understand a financial product making a real comeback right now, hit that subscribe button. Every week on First Million Club, we break down exactly these kinds of real money stories with real numbers, so history doesn't get to repeat itself quietly.